towards the board of directors at Arndt Industries and will discuss the strategic and future direction that we at KAM Enterprises recommend. I am Jane Ingram, and I am here today with my team Nirav Shah, Ephraim Pano, and Tyler Revel. First, I'd like to go over today's agenda. To begin, I will discuss the overreaching situation at Arndt, which will include an analysis of internal, external, and financial factors impacting the business. Next, Nirav will discuss the major issues at Arndt and alternatives for each. Subsequently, Tyler will begin the discussion of our recommended implementation plan, which will be concluded by Ephraim, who will also discuss performance metrics and will sum up our presentation. To begin, Arndt is a privately owned producer of manufacturing equipment and systems, meaning that they operate in a very capital-intensive industry. Recently, there has been stagnant growth, but the shareholders aspire to exceed $500 million in revenue by 2019. Our presentation will discuss opportunities for Arndt to grow and what will help and impede them during this endeavor. From a strategic outlook, Arndt's mission is to manufacture innovative quality products through its diverse subsidiaries. Currently, the focus is in the interest of the stakeholders is to expand the business and to create a viable succession plan. The shareholders will be actively involved in the business during the process of reaching these goals. From an operational standpoint, the strengths that I would like to highlight at Arndt are that they have many years of experience in the business and a knowledgeable board of directors, have a strong brand name, loyal employees and suppliers, and capacity for growth. The most prominent weaknesses that KAM considered during our recommendations are that Arndt has issues with dealers breaching contract, has incompatible performance metrics, operates below capacity, and heavily relies on the railroad and ocean transport systems. We performed an external analysis and identified low labor costs in South America, an improving economy, and favorable South American tax terms as the overarching opportunities, and changing government legislature, public sector budget cuts, and increasing fuel costs as the overall threats. As you will note in our report, we also considered threats and opportunities within the agricultural, engineering, and railroad industries as they are the ones which predominantly affect our business. We performed a Pestel analysis and determined other external environmental factors that were considered during our recommendation. I would like to highlight first that entering developing countries may be financially viable given the demand for Arndt's technology. Second, that Arndt is an industry where technology develops quickly and may become obsolete. And thirdly, that environment regulations over carbon emissions may be a threat to Arndt's profitability. As the final portion of the situational analysis, we have looked at Arndt from a financial standpoint and have noted that although Arndt's liquidity and solvency have been improving, it is weaker than the industry average. That being said, Arndt has significantly higher return on equity and on assets than the industry, and we therefore commend the current investment strategies. Nirav will now discuss the issues and recommendations of alternatives at Arndt.
Thanks, Jane. I'll be now talking about the major issues and analyzing them with Arndt Industries. Firstly, the first alternative would be having a genset locomotion. So we would like to grow Arndt's profitability by $500 million in sales by 2019. The goal is to create environmentally friendly locomotive over the next 10 to 20 years, and there's basically two options to this. The first one would be to develop it in-house, and the second one would be a joint venture. A lot of the pros and cons to this in general would be less fuel consumption, and which would produce 16% less greenhouse gas emissions potentially. Secondly, consistent with AL's mission statement and value discipline, and both options would deliver positive NPV using 10% required rate of return. Some of the cons would be first, there's a lot of fluctuation in the raw materials and the industry, which affects the costs. Secondly, it's cyclical, which is it has spectacular highs but has industry saving lows. And thirdly, it is dominated by a few large competitors, which also brings an issue. The first alternative would be in-house. The pros of that would be to leverage Arndt's brand and reputation for quality. Secondly, strong relationship with suppliers, which gives assurance of supply and the price. Thirdly, to make use of idle capacity. So the situation right now is that currently they're only at 63%, and by having it produced in-house, we would be able to use the remaining to push it up to 100%, and to be able to exploit the Canadian reputation worldwide for providing expert advice. Cons would be it's 3 years to bring to the market. There's a $7.5 million investment required in year 7 for capacity upgrade, which could be problematic. And there's a cost of genset locomotive is 6 times more than the old diesel model. The second alternative would be a joint venture, where Arndt Industries would join Energy Locomotive, which I'll be referring to as EL. The good stuff about the pros on this would be to gain access to a new market, having EL, which is a great presence in the environmentally friendly locomotive market. Secondly, to gain access to different skill set, complementary technology, which helps give them a competitive advantage. And thirdly, diversification of risk. What this would do is EL has a good reputation in the industry, and we would be able to help share resources between Arndt Industries and Energy Locomotive. Some downside to this joint venture would be cultural issues that may hinder the decision making. Secondly, there would be a great increase in risk. How would this happen is pretty much EL has been unable to continue genset research and development due to financing problems. And lastly, the tax implications working with the US. And there's obviously foreign currency exchange risk. The second alternative would be to acquire TB mining. Pro side to acquiring TB mining is that TB currently has a proven track record and good reputation over 60 plus mining customers. Secondly, it satisfies objective of positive NPV through 10 years and contributes achieving revenue target. And thirdly, experienced with aftermarket sales service, and it will definitely help us improve our current research and development. Some cons to that would be operational issues, which is capacity at 70% for a plant, 2 other companies interested in buying it as well, and there's been issues with its weak turnover, improper cost estimation, poor quality control, and faulty equipment. Third alternative would be expanding to Peru. The good side of that would be to take advantage of opportunity in the profitable markets of South America with legal stability over a 10-year margin. And the biggest downfall of that would be the political landscape, which is really unstable, which in turn could affect our business in a negative way. What I would recommend after listing out the major issues would be to pursue JV Genset as an alternative and to purchase TBM. The combination of these 2 alternatives
As Narav mentioned, I'll be discussing our implementation plan. TB should continue to prepare their financial statements under IFRS. These statements will be converted to ASPE at consolidation, and while this does have some negative associations such as increased costs and an inherent risk which will be heightened resulting in potential errors, we still think this is the best alternative. For the succession planning at AI, it's critical that AI shares be transferred to recipients at not less than fair market value, since this will result in double taxation. The transfer would trigger capital gains for the transferor, but the cost base would not be adjusted for the transferee. If sold in the future at a value greater than the original ABC, taxation on the same gain would result. AI should instead consider an alternative, which is an estate freeze, whereby the intended heirs of the company will subscribe to new shares at a nominal value without triggering tax consequences for the existing shareholders. There are a number of taxation issues which will need to be addressed as part of the implementation. First, there may be a possibility that AI could use beneficial accelerated capital cost allowance as a result of R&D activities related to renewable energy, the industry that they work in. AI should consider if legal and warranty costs, which have been deducted, were treated appropriately as well. Only warranty costs that have actually been incurred due to customers coming back with warranty issues should actually be expensed. A warranty provision should not. Similarly, legal costs can only be deducted once a legal settlement or a judgment is made. Legal retainers or provisions cannot actually be deducted. There are also some tax issues related to inventory stored abroad by AI. AI will need to determine if the offshore inventory holdings represent permanent establishments in legal jurisdictions, where this may have an impact. Further, AI will need to investigate and consider any bilateral tax agreements, which could impact either the acquisition of TB mining or alternatively the joint venture. The acquisition of the mining company raises a couple of tax issues itself. Since it is an acquisition of shares, there will only be an adjustment of the ACB of non-depreciable assets, in this case primarily the land, while other assets would not be adjusted to fair market value. AI will need to consider two alternatives. While Canadian operations of the target may be eligible for favorable tax treatments, such as enhanced CCA and SHRED, these benefits will need to be weighed against the potential benefits of having control of the joint venture, which could eliminate or exceed the benefits previously mentioned, such as the SHRED and the CCA acceleration, because only a CCP would be eligible for those benefits. Regarding the legal issues faced by AI, our qualitative analysis kind of trumped our quantitative analysis in that situation. While the weighted outcome suggests that fighting the settlement and pursuing the court battle would have a net benefit of $250,000, the qualitative issues such as loss of this customer, potentially damaging our reputation, and other issues could have much worse negative long-term implications for the company, and there is also the possibility that we could lose the lawsuit. Finally, one more implementation is that we will be implementing the customer relationship management. With some minor changes, we will be able to enhance the relationships that we do have with our customers and prevent some of the issues that have been discussed going forward.
Thank you, Tyler. Right now, I will be discussing share valuation. And by applying the discount cash flow model as well as the dividend discount model, what we have realized is that we can achieve a price of $180 per share, and that this is actually beneficial for customers or shareholders of AI in that they can sell their shares at a fair market value, given that the price of AI has increased dramatically from their original issuance. Second off, we have to look at quality control issues. AI implements Six Sigma principles, whereas EP and RRP do not. One of the major issues with EP, though, is that they implement their quality control at the 25% or the 50% completion rate, and as a result, they have warranty provisions of 5% of net sales, as well as faulty equipment leading to the prompted lawsuit. One of the recommendations is that they increase their quality control by 1% of sales, and in doing so, they will be able to mitigate their warranty provisions by 1%, as well as over time, they can decrease it to the 2% benchmark, and in doing so, they can implement their transfer pricing after. Dealership issues have also arisen. We recommend an audit function of $600,000 a year so that we can make sure that the dealers are providing them with the correct warranty provision expenses. In doing so, what we also recommend is that they retain the dealer that was able to bring to their attention the faulty warranty claim, even though a settlement has been reached, but let go of those dealers who are in breach of contract and implement legal action against them, given that the reasonable estimation for the settlement will not be known. It will have to be disclosed within the notes. Dividends have also been an issue. The board of directors have approved dividends with the draft financial statements not being finalized. What we recommend here is that the board only approve dividends when the financial statements have been finalized, as well as a cash flow budget has been prepared for the next fiscal year. As a result, some of the reasons for this may be due to if the financial statements are inaccurate, then there may be taxes payable, or they may be based on inaccurate information. Financial statements have also been a concern. What we notice is that there are discrepancies between the accounting principles regarding revenue recognition as well as expenses. For instance, with revenue recognition, there are some dealers who will tell them what the consignment sale is, various methods to measure costs, as well as whether they should capitalize or remove some, or capitalize or expense some items. We recommend unifying based on one principle, either IFRS or ASPE, as well as hiring more accounting staff. Lastly, we have our performance measure. What we recommend is that based on the balanced scorecard, that the 60% of profit sharing for the executives should be tied to these measures. And in doing so, we are able to have both financial as well as non-financial results. And utilizing this, we're able to make sure that the company is able to realize which measures are impacting not only their financial results, but if there's other non-financial items that are impacting them as well. Well, in order to wrap up, what we do recommend is that AI pursue the JV with Energy Locomotives, and in addition to this, that they also pursue their acquisition for TB mining. The $20 million bank loan will be able to help them out. They'll be able to increase their revenue stream, return on investment, as well as return for shareholders. Thank you.
Thank you for taking the time to listen. That concludes our presentation.